This is the 10-Minute Contrarian Podcast. This is VP. We are a solutions-based podcast, diving into the world of contrarian investing and alternative finance. You can find us hosted on the No Nonsense Forex YouTube channel, NoNonsenseForex.com, and podcast players everywhere. Episode 264 is brought to us by ByBit. Speaking of ETFs, you can trade and or hold up to 10 ETFs right now on ByBit, and that catalog is expanding fast. They have QQQ, they have the semiconductor ETF, SOXX, they have the main Japan ETF, the main South Korea ETF. That's an interesting one. ByBit is becoming the one-stop shop for pretty much everything you will ever need. And if you sign up through my link, which you can find on the ByBit blog down below in the show notes, click on it, scroll to the bottom, you will see the link. Sign up through that link, and all throughout your entire history with ByBit, you will get all sorts of bonus promotions and enhanced customer service should you ever need it. The whole world's going blockchain, contrarians, and the blockchain native platforms are going to lead the way. So sign up now and enjoy all the benefits, because with ByBit, membership has its rewards. It is the 10-Minute Contrarian Podcast, Sunday edition, and this time around, it's weird because what I really like to do here is be a contrarian. I like talking about things when most people are decidedly against them. A bonus if I can get opposing comments in my own comment section on YouTube. That shows me that I am on the right path. But I've been waiting to put this episode out for a while now. And if I was really being contrarian, I would put it out when the market is booming. Because then you're being contrarian, because you're trying to let everybody know about these instruments that produce anywhere from maybe 6 to 10% dividend earnings per year. And then the pushback during those times is going to be, well, I just made 50% on this particular investment this year. Why on earth would I be interested in dividends that do something like this? But now, with everything down, I think more and more people see the value of having things like this anchoring your portfolio. This is something old money does. They probably keep anywhere from 50 to 75% of their money in some type of dividend product. So if the market ever does turn down, they will always be okay. They will always have income being generated. You see this strategy in family offices everywhere. Now, I personally think it's smarter to have a pretty sizable gold allocation along with this strategy. But dividend earning products absolutely need to be anchoring your portfolio. If you have all risk assets in your portfolio, I really think you're doing it wrong. You need to start with a base first. Now, you're going to have those products like SGOV, for example, or even better in some cases, yield earning stablecoin products on the blockchain. Or, let's be honest, a combination of both is probably ideal there. That needs to be at the bottom. But then on the next tier up, that is where you're going to have your higher yielding dividend products, your dividend ETFs, your CEFs. If you missed that episode, make sure you run a search for closed-end funds on this podcast. Because in my opinion, if you do this right, this is going to also become a sizable portion of your overall account. I mean, hopefully, if all goes well, into my 50s, this is going to be an area of pretty high focus for me. Will I ever stop passing up on really great opportunities on the higher end of the risk curve? No, of course not. But as you get a bit older and your portfolio gets more defensive, you're going to be really glad you developed this particular skill and you are familiar and you know your way around these dividend products. Because let me tell you, they come in all shapes and sizes. And the three we are about to go over here in episode 264 are going to be three very interesting offerings, all three of which I've taken quite an interest in. I already have a handful of these products now, but if some is good, more is better. And diversification matters. So I have been waiting to bring these to you for probably over a month now. So we'll go ahead and get into that now. Real quick, I just want to say I am not a fan of covered call ETFs yet. I'm still taking a sit and wait approach. I want to see how these things really hold up during a legitimate recession. I don't take any interest in them until that moment comes. Not to say anything bad about them. They just aren't battle tested the way I want them to be just yet. They have lost out to their counterparts in many ways on the upside, but what they're really good for is like if you really need the dividends and you're living off of them, or you have a strategy where you're really trying to compound the dividends themselves. There is certainly a time and a place for these. I have seen several of you put covered call ETF strategies together. It just won't be talked about much here. But I do want to talk about some higher yielding dividend ETFs because I think if done intelligently, you don't have to sit there and get the same low yield everybody else gets. And for what it's worth, I don't think we're done with high inflation. I think we will certainly see it again, if not soon. So being able to beat the inflation rate on these is going to matter too. Now, you guys know I try to burn the candle at both ends as far as inflation goes by living in a cheaper country, so American inflation doesn't affect me nearly as much. But if you haven't made that move yet or don't planning on making that move, then you're going to have to make it up somewhere. And playing in that 6 to 10 range, percentage-wise with dividends, is going to be an important place to be, especially if you're paying taxes on them, because that's going to shave it down. But before we started, I really wanted to express the importance of more defensive assets like this, to where they are defensive, but you are playing a bit of offense at the same time, and you're getting guaranteed money from the product itself, which always matters. Episodes like this are not going to get the numbers that a macro episode would or some crypto episodes. But the people who are going to win at this game are going to understand the defensive side better than the ones who don't, and that's why I harp on this as much as I do. So, enough of that. Let's go ahead and get into these offerings. The first one I want to talk about is an ETF I didn't always like, but they've made really great changes recently. And now I think their allocation is just awesome. So if you're looking for something that spans throughout all the different types of closed-end funds that we talked about in the closed-end fund episode, so like a really nice broad-scale ETF for this, that's on its own paying out better than a lot of closed-end funds right now. And that's going to be the Global X Super Dividend ETF, ticker symbol SDIV. And this thing has every type of CEF you could want, as far as REITs, MLPs, senior loans, BDCs, all those great things. The team at Global X has assembled what they think is the best of the best here, and also given international exposure. Now, when I hear international exposure, based on what we know from a macro sense right now, I'm like, do I really want to be exposed to internationally? I mean, it's looking pretty grim for a lot of regions in the world. But international exposure here is almost 50% United States and Brazil. Brazil is a country I'm a bit higher on going forward than a lot of countries in the Eastern Hemisphere. So I don't really mind the international diversification here. I do like the fact that they're a bit more heavily weighted into MLPs. MLPs, if you remember, are energy-based products. And what's great about those is you can really do well with them in recessionary times, apart from the fact that we absolutely love energy here at the podcast. So instead of trying to assemble all of this yourself, SDIV just does it for you, and I think they do it really, really well. Now, in terms of what kind of yield they give you, well, it's going to vary, and it's your job to keep track of this variance. But the year-to-date yield for this particular product has been 8.75%. And currently, you can get it at a 9.28% yield, which is excellent. I mean, this is really where a lot of individual closed-end funds live, kind of in this range. So whenever I see something that is a collection of closed-end funds in an ETF wrapper, you can always kind of knock down a couple percentage points. And you will find a lot of, quote, dividend ETFs somewhere in more like the 5 to 7% range. But not here. So not only is this one on my radar, it is near the top. Now, here is the catch. And this is a catch for some people, but I don't think it's a catch for us. If you pull up the chart of SDIV right now, go to the monthly and zoom out just maybe a little bit past 2020, you will see that when the market does not do well, neither does this product. And this is something you will see all across your higher dividend ETF ecosystem, along with closed-end funds. So what you will need to do here is be diligent. And to me, it's very easy. When you get a bearish signal, you simply let these things go. And then when you get a bullish signal, you simply bring them back. Quite easy. Yet, most institutions still don't seem to really know how to do this, and so as you can see with a lot of these, they decline in value over time. So if you're just buying and holding these things and not doing anything else at all, you are certainly not getting the best of it because the long-term losses are going to cut in to all those great dividend earnings you're going to get along the way. And who wants that? So if you're going to hold these, I would just say simply check in at the end of every month and see what the chart says and adjust accordingly. If you put your own system onto something like this, I think you're going to see that those signals don't even come up all that often. So there's not really much to do, but you still have to pay a bit of attention. So when you get a bearish signal, rotate back into something like SGOV, or depending on where you are in the world, I'm sure there is a product, a bond product where you can get some good yield. And then when it's time to jump back in, you simply jump back in. But speaking of all that, let's go ahead and move into a product that so far, at least, I think it bears a bit more watching. But there's a yield product out there which, at least recently, has completely thumbed its nose at the tariff tantrum, for example, and has also really not cared either way about the war in Iran. Didn't even get phased, didn't care one bit. Just kept right on increasing in value and providing their investors with a fantastic dividend. So I am intrigued. What a weapon this could be going forward. And the ETF I'm talking about is the Simplify Currency Strategy ETF, ticker symbol FOXY. So foxy. Now Simplify, I think at this point is one of the top 10 ETF issuers on the planet. And what this does is pretty much it's almost like a carry trade ETF where they sell low yielding currencies and buy higher yielding currencies, such as the Mexican peso, Indian rupee, not complete junk currencies, just ones that give you a higher interest rate. So to all my Forex traders out there, you should be very comfortable with something like this, or at least you should understand the mechanics more than most people would. So again, this thing is not very old. It debuted back in February 2025, but it has steadily gone up ever since. And this ETF, throughout all of its prosperity, is currently giving you a 7.55% dividend yield. So certainly add this one to your radar. How nice would it be to have some of these products that will give you a higher dividend yield and not crash with the economy should it ever crash? I don't ever want there to come a day where I have to remove 80% of these things from my portfolio because I'm worried about the economy crashing. It'd be really great to have certain products in there that can still give me yield and I don't have to sit there and remove. And I'm telling you right now, Contrarians, these things are not easy to find. I'm constantly hunting for them. So even though this one is fairly new, I am very excited to put it on my radar and possibly add it to my portfolio. And I challenge you to find ETFs that do similar things. Now, if you want to go to YouTube, this podcast does go to YouTube, and go to the comments section and talk about some of the dividend ETFs you like, especially if you can find some which don't drop when the market drops. So look back to 2020, look back to 2022. And assuming these things were around back then, look and see how they performed. I am more than happy to get some extra suggestions from you guys. In terms of dividend yielding ETFs, I can also put on my radar here. But I have saved what I think is the most interesting one for last. Now, I have no idea what the yield is going to be on this because this ETF is not even out yet. It is scheduled to release in September, and there are actually going to be two of them. And what it does is, even though it is not going to be on the blockchain, it's going to be a traditional ETF, it is going to allow you to collect your dividends in Bitcoin, which I think is great. Everybody is looking for passive ways to earn Bitcoin. It's not easy to do. It's a proof of work product, unlike proof of stake, which is much easier to earn yield on. But the chance to be able to earn dividend yield in superior money is something that I am going to really take a look at. And Franklin Templeton, a very large issuer in the United States who has been very pro-Bitcoin and pro-blockchain, is coming out with what they're calling the DRIP BTC ETFs. Again, there's going to be two. We don't know exactly what they're going to do, but the goal is to pay you out in their Bitcoin product. So along with, BlackRock and Fidelity and ARK, Franklin Templeton has a Bitcoin ETF. I think it is probably the last place Bitcoin ETF in terms of popularity. But by last place, I mean like a $330 million market cap. And if I had to make a choice, I would certainly rather have Franklin Templeton's Bitcoin product than Cathie Wood's Bitcoin product. I'm not sure why one outranks the other, but hey, not our problem. So their Bitcoin product, which is ticker symbol EZBC, is going to be the reward here. How much of it you're going to get, I do not know. What are you getting on the other end? Well, it's supposed to be more of kind of an index-weighted ETF, skewing more heavily into tech, which has its moments of going up and down. We know that. But tech just continues to eat the world and probably will long-term for quite a long time. So maybe in addition to something like QQQ or QQQM, tacking something like this on and earning Bitcoin in the process. Say no more. I am absolutely on board. And I'm really grateful that there's so much creativity in the ETF world right now without getting too cute with it and while still having dividends and a bit of defense in mind. I mean, you have some of these gotten a bit out of control, yeah, but again, not really our problem. And options are good. I'm glad they exist. The downside is there's going to be more you have to sit there and sift through, but when you do, you can really find some interesting options out there, superior options, in my opinion. And I pity the fool who does not understand the importance of being able to generate yield on the more defensive side of your portfolio, which is the most important side. So in this Sunday edition, I hope you can put these on your radar as well. And if anything, if you're not paying too much attention to this space, pay more attention to it. Because if you're able to win this part of the game, it's going to be really hard to lose overall. And young, inexperienced investors probably don't understand this just yet, but the rest of us have no excuse. I don't know how prosperous the economy is going to be in the next 15 to 20 years. If for some reason it's not amazing and you still want to retire, you're going to need to understand this part of the game. And I know it's not the most flashy, interesting material out there, but it is nonetheless probably some of the most important. So again, let me know in the comments section what you have, especially if you don't have access to the U.S. market. For one, you're probably going to have more and more access as time goes on with RWAs, and that's awesome. But let me know if you have some interesting products on your side of the world as well, and tell us what they do. But as stated before, get a head start. Start earning real yield with these things and take advantage of them. Because nothing about this is crazy. The only thing crazy is not starting this as early as possible.